Okay, hi everyone. My name is Richard Perry. I'm market analyst and I'm working with INFINOX and providing webinars and content and videos and everything hopefully that you're receiving for your analysis content is our production. And yeah, we're going to do another monthly webinar for you. And before I kick off, I'm just going to quickly show you the very short disclaimer, but it is going to be a webinar where we're going to be talking about live market information. So it is just that, it is just information and not to be constituted as investment advice for you. This is, yeah, I mean, but we're going to do a webinar where we do the usual agenda, where we look at the big picture macro driving factors behind what's happening through markets, and then we're going to pick into different asset classes. We're going to look at forex, we're going to look at commodities, and we're going to look at indices as well. And at the end, if anyone's got any questions about your trading, just drop it into the Q&A box, and I will do my best to answer your questions at the end. But yeah, it's a Q&A that we'll be having at the end. So if you're sort of wanting to interrupt halfway through, we're not going to be able to do that. We're going to do it towards the end. Okay, so kicking into it, looking generally at markets, always we have interesting months when all the central banks are reporting, and this is the coming month in June is, I think, going to be another interesting one where we do have all of the 8 major central banks giving monetary policy updates this month. And for that reason, certainly the one on the top, the Federal Reserve, is going to be front and center, because the June meeting of the Federal Reserve is a meeting where we get the economic updates of the projections of forecasts, and also we get the dot plots as well, which is always really important for where the Federal Reserve Committee see monetary policy moving. Now, the sort of expectation is, I think, towards the back end of this year, we're going to see the Federal Reserve moving towards stopping its asset purchases, and how the Federal Reserve now starts to guide for that move, because it's likely to come in probably the December meeting, where they actually say, right, we're going to start cutting back on asset purchases. They will not do that straight away like that. They will guide in the meetings coming up to that, or meeting, more than likely it will be probably 2 meetings, maybe 1, but maybe 2. Before that event, they will start to guide markets for that. So we're now in the process of looking for the sort of language changes from the Federal Reserve that could give a hint as to when that might be. And we may start to see that in June. It's still not likely, but there may start to be some little hints in the Federal Reserve meeting in the coming month that might start to hint at tapering asset purchases further down the line. Now, how markets have been reacting to really quite significantly rising inflation expectations and inflation indicators has been one of the key themes in the last month. And this growing inflation risk that we have is a really important factor. Now, you can see here, this is the chart of US inflation, and it started to rocket higher, certainly on the headline CPI and core CPI basis. And we're likely to see also the core PCE, which is the core personal consumption expenditure, which is the Federal Reserve's measure of inflation. That's also likely to start to accelerate higher. And if, well, I say if that happens, as that is happening, that is having quite a significant impact on markets, basically because of the expectation of inflation and the expectation of growth are the 2 key factors that drive bond markets, and bond markets drive foreign exchange markets. So how the US Treasury bond markets move will have a really significant impact on how the dollar moves. And that is a really key factor in the fact that, if I show you here, and here. And we can see here, this is a measure of inflation. Inflation is currently in the US on a 10-year basis, looking at around about 2.5%, but the bond yield is only 1.65%. So effectively, you've got a negative 0.9, as you can see down the bottom here, 0.9 negative on the real yield basis. So in terms of interest rates, they are actually negative by 0.9. So that's not positive for the dollar. And when that line moves down, it means that the dollar comes under pressure. And you can see that, sorry, not that one. Let's see if I can find it now. This one here. You can see that line falling to minus 0.9, coming with the dollar falling as well. So these two are very strongly correlated. So falling negative interest rates and negative for the dollar. So dollar related pairs are the dollar is getting hit from all sides at the moment, and you can see that how the dollar has moved in recent weeks as that negative real yield has started to fall back again. The dollar index has come under pressure to the downside, and we've seen that really impacting through markets. So that falling dollar is a really a big function of those increasing inflation risks, and that is a key factor that is driving markets still at the moment. So any indicators that come out from the US, such as inflation, such as retail sales, anything that suggests that inflation is building in the United States is having a negative impact on the dollar, and that is why we're seeing the dollar falling. So does the Federal Reserve react to that is the question, and does the Federal Reserve start to use less dovish language and start to guide towards the end of this hugely loose monetary policy that we have through the major central banks? And European central banks, similar sort of issues. We can see that bond yields in the Eurozone are moving strongly higher suddenly. And that now means that the European Central Bank has some questions to answer, I think, on June the 10th. How does the European Central Bank deal with the fact that bond yields in the Eurozone are now suddenly moving quite strongly higher? You can see here, all of these bond yields are now moving strongly higher, as not only there are two aspects to this, again, inflation and growth expectations. Now, the growth expectations are also improving in the Eurozone because the vaccine levels are starting to really now pick up. And I've got actually a chart here. Zoom in a bit, and you can see here, these Eurozone lines here, Ireland, France, Italy, Germany, are all accelerating higher. Now, it's interesting that the front runners in this, the UK, that line slightly tailed off. The US, again, another front runner, has slightly started to tail off. So this is coming as the Eurozone numbers of vaccines are really going. So the market spent February, March, April, all sort of factoring in strong US, strong UK. Now, we're starting to see, I think, the Eurozone picking up in the vaccine front, and it's not surprising to see that we're now starting to see these Eurozone bond yields go higher, and also the euro is strengthening as well. So that's a positive for European markets, so these bond yields going higher. But how does the European Central Bank react to that? Because they are, again, ultra loose on monetary policy. How do they respond to that? Do they start to sort of tail back? They're now coming to the end of this this phase of front-loaded PEPP, which is Pandemic Emergency Purchases Program, the quantitative easing that it introduced. They're now coming to the end of that 1 quarter front loading that it has. So what do they do now? That's the question on the 10th of June. Across these other major central banks, I'll sort of just pick out the Bank of England, because again, the Bank of England is another central bank that's slightly starting to move towards removing these emergency pandemic measures. Slight tapering in its last meeting. What does it do for the next meeting on the 24th of June? And other reserve central banks, Australia, New Zealand, we're not really expecting too much from those guys. Maybe from the Bank of Canada, though. Maybe from the Bank of Canada, again, possible taper there. But the key thing is all these central banks coming in June. As I said, other aspects is the inflation risk. How are these inflation risks playing out through markets? Fiscal spending from both the Eurozone and the US. Joe Biden, he's already put through 1.9 trillion of fiscal support. He's looking for another $4.1 trillion worth of fiscal support to go through in various packages that he's trying to get through Congress. Now, how well does that get through? Because obviously that all needs to be paid for, and the question is, how does it get paid for, and does it get scaled back? Is that? And finally, the EU Recovery Fund, 750 billion measured against the US. It doesn't sound like a great deal of money now, but still 750 billion shouldn't be sniffed at. But it's still sitting in the courts at the moment. And can the courts now start to free up that money so it can be spent in the Eurozone? Again, that could be a positive for the Eurozone if that comes through in the coming month. A couple of aspects I've got here at the bottom. How does the Indian variant of COVID affect countries? I mean, at the moment, the UK is starting to sort of pick up in these, but does the vaccine rollout in the UK mean that it's not so much of an issue? If it picks up in the Eurozone and the EU, has the EU got enough vaccines to cope with that? Would be the question there. And finally, Israel-Palestinian tensions. It makes harrowing viewing actually on the television, all these bombs going off. But does that now spill over into the Middle East? It's a tail risk, but it's a possibility that other countries could get increasingly worked up about it, and that wouldn't be positive for risk appetite.